Good day, fellow investors. We recently discussed Apple in our intrinsic value video, but there are also some questions that I want to touch on deeper, and that is Apple's situation in China, perhaps not just China and the decline there, and Warren Buffett calling Apple's buybacks stupid. And yes, Apple is the most beautiful of them all, but it is also likely the most expensive, as we have seen here with the intrinsic value versus the stock ratio. The most expensive of the stocks we have analyzed now, and we have to now see how is this impacting Apple as a stock and the situation. 17% decline, China iPhone sales down. This reminds me of 2016 when there was also an iPhone China decline slowdown scare. 2% of global decline for Apple, 2 there, despite the market growing 4%. And yes, there is service growth, there is Apple Intelligence coming, and how will that impact Apple's profitability is still unknown. And then there are always the buybacks. So let's go through the key factors and see what Wall Street is expecting, what's priced in, what's not priced in, and what's a conservative value investing intrinsic value of Apple. If we look at Wall Street, nothing wrong there, just growing constantly 10%, and then as services and AI take over, going to 12% and faster growth for Wall Street. However, they are expecting this huge growth going forward, while this is the reality. 1, 2, 3 years of practically no growth, actually decline if it wouldn't be for buybacks. That's just a few percentage points per year. And the question is, what comes next? What will be the future of Apple? But coming next is not really value investing. With value investing, you want to get value, you want to buy value for what you pay and get the upside for free. There are risks. 19% of sales are from China, and despite the market hating China, that factor I don't think it's even related to Apple, therefore it shows also the market's irrationality, plus everything is produced in China. So I think Apple is a China stock, but it has such a beautiful P ratio. The stock just keeps going up compared to Chinese stocks. But okay, that's just how I see it. If we look at the most recent announcements, the big one is that Apple will keep doing 110 billion of stock repurchases minus 10 billion for stock compensation that then gets to management. So they will keep on buying back 110, but effectively the buyback yield is 100 billion. The thing is that they are doing those buybacks now with the market cap of 3.5 trillion, which means that the buyback yield is 3.1% when you divide the buyback spent on the market capitalization. And if we go to the last Warren Buffett Berkshire letter, he mentions Apple just once, and he discusses then buybacks, how Coke did buybacks, Amex did buybacks, and therefore Berkshire shareholders have a higher ownership in those businesses. However, like in every letter, he says that the buybacks are okay, but to this obvious but often overlooked truth, I add my usual caveat. All stock repurchases should be price dependent. What is sensible at a discount to business value becomes stupid if done at a premium. I don't think Tim Cook will be on the ground in Omaha next meeting, because there is a huge difference doing buybacks here when Warren Buffett was buying Apple hand over fist, and doing buybacks here now that the stock is a 10x while earnings are a 2x. That is stupid according to Warren Buffett, and Apple spent 800 billion on buybacks, on which 400 billion or more in the last few years here when the stock price was already very high. But Tim Cook's goal is just to push the stock price higher, even if it might destroy Apple going forward. No matter the price, he just wants to push it higher and higher. But to get paid, again, another Warren Buffett quote, the only one who makes the money on stupid buybacks is the one selling Apple stock. Who has been the greatest seller of Apple stock lately? Warren? I don't know. Nevertheless, we discussed also the inelastic market hypothesis, which is something I suggest you go and watch how these buybacks are impacting stock prices and pushing stock prices higher and higher. Check if the management is just selling a little bit every time to get paid a little bit more on those buybacks. But let's check how Apple fits our intrinsic value, what's priced in, and you can also calculate that with the table. Here we have our intrinsic value template. We go to Apple, you just click, and here we have the stock price, the dividend payout ratio, earnings per share, $6, and now the question is, okay, how fast will Apple grow going forward? If earnings per share grow at 5% and the multiple gets lower, not to a P ratio 40 like we have seen last month, but to a normal 20 for a slow-growing company like Apple, the intrinsic value, if I expect a 10% return, a 10% discount rate, the intrinsic value is 80, compared to the stock price of 228. Call me crazy, but I would go insane if I would be normal like Wall Street. Okay, let's go to a best case scenario to see maybe what is Wall Street pricing in. Then I have to put a growth rate of 10% of earnings for the next 10 years and a terminal multiple of 40 so that the P ratio 40 stays for the next 10 years. Then if I want a 10% return from Apple, only then the current present value sum is okay. But I think that's too exuberant. Let's put 7%. This means no recessions, no China hanky-panky, nothing happening for a 10% return. Maybe the market is just happy with a 6% return from Apple, and then we put a 25 valuation here, and still it doesn't cut the current stock price. So high valuations forever is what is priced into Apple, or staggering growth for higher returns. But you want a 10% return. That is what stocks give, no? So the market is then pricing a 40 P ratio, so 12 and 10% growth rate going forward. Or perhaps a 30 P ratio and 12% growth going forward, even faster maybe next year, 14, here we are. These are huge growth rates, and I'm going to leave it like this because, okay, that is what the market is pricing in now, and let's go to a worst case scenario margin of safety. Let's say there is a recession, who knows what, no growth rate for Apple, and the P ratio goes to 12. I'm old enough, and I remember analyzing Apple when the P ratio was 12, even 10. Call me crazy, in that scenario the present value of Apple is 34, the money has been spent on buybacks. If the cash flows go down, we'll be looking at that price. For now, Apple is doing good, buying back modes, whatever, but you never know. And that's why Warren Buffett sold. So we still have the probabilities left. Best case scenario, I'm going to put 15% chance here. I'm going to put also a 15% chance on the worst case scenario, no worries. And we are left, if my math is right, with a 70% chance for a normal scenario. Okay, let's just make the market a little bit happier, but I'm not touching the 20 multiple. So intrinsic value is 100. The stock is significantly overvalued for that situation. And here is the article from March 30, 2016. Huge cash per share then, and the P ratio of 10, because everyone was thinking that Apple has no future. I think Apple can have a future, but that's exactly the difference between value investing and everything else. Now that the stock price is higher, everyone is betting on the stock going even higher. The key factor is price when it comes to investing, and I want to get my P ratio of 10 for Apple and then have all the upside for free. That is when Warren Buffett bought. I did also buy something in 2016. That's a different story. However, now, if I look at Apple and our intrinsic value, I don't think over the next 10 years there is a positive return for Apple shareholders. Even if Apple doubles earnings per share in the next 5-6 years, that is very hard that they will repeat it again. Therefore, the valuation will contract and you have a zero. So that's the best case scenario, Apple doubling earnings. So this is my opinion on Apple. I'm sure many of you disagree. I'm looking forward to your comments.